U.S. stocks have gotten crushed this past year, and long-dated U.S. government bonds have not fared any better. Look at TLT, the 20-plus year U.S. Treasury Index. You're looking at down nearly 40%. Is there anywhere safe to invest? Well, energy stocks have actually performed really well. Look at Exxon Mobil making new highs. What do I think about Exxon stock? XOM is the ticker. What do I think about energy prices in general? If this is your first time tuning in, my name is Daniel. You're watching Unrivaled Investing. So let's dive in to understand what's going on with Exxon Mobil. Well, to understand what this is, this behemoth in energy production, they have proved developed reserves of oil equivalents of 10 billion barrels around the world, spread across the United States, Canada, Europe, Asia, all over the world. And when you look at their results, you can see that around $10 billion plus of their earnings in the second quarter was due from the actual production of energy, oil and gas, most of it non-US. And then you also see around $5 billion generated from, let's say, the refinement of various different, energy sources, turning it into fuel, maybe jet fuel, maybe diesel. And so you see that these two key sectors, the upstream and energy products, generate the vast majority of ExxonMobil's earnings. You see in the second quarter, they generated around 18 billion in earnings. And you see the upstream was around 11 billion of that. Energy products was around 5 billion of that. You do have other segments like chemical products and specialty products, things like making various different plastics, lubricants, things like that, but much smaller relative to the actual production of oil and gas. And so you're looking at a business that in the last quarter generated 17 billion in free cash flow, a little under that, and a little under 30 billion in free cash flow year to date 2022. So this does make me wonder if ExxonMobil is going to be generating around 50 to 60 billion in free cash flow this year, or on an annualized basis, it sure looks like it's in that range. Now, keep in mind, this is relative to a market cap of around 450 billion, so around 7 to 8 times free cash flow. And this does, strike me as very interesting, because when you have a company trading at, let's say, under 10 times free cash flow and management's returning a lot of that free cash flow to you as a shareholder, it's very easy for you to start penciling out what your return could look like if operations are stable. If you look at a company trading at, let's say, 10 times free cash flow and they return those cash flows to you as a shareholder, that means you're effectively getting a 10% yield. Whether or not that's through dividends or buybacks, that is a potentially very attractive return, once again, if underlying operations remain stable. So 7 to 8 times free cash flow is even more appealing than, let's say, 10 times. And you can see ExxonMobil year to date, returning around $7.5 billion to shareholders via dividends, another $6 billion via buybacks. Last year, they were paying down their debt, so moving from cleaning up their balance sheet to returning free cash flow to shareholders. Not surprising to see Warren Buffett buying tens of billions of dollars in energy stocks. I think it's partly because he sees the price. I think it's also because he's a student of history. He's seen, usually when you have wars, like what you're seeing going on with Ukraine, it results in elevated deficit spending. And when you have elevated deficits, yes, you can print more money. Yes, you can print more treasuries, but you can't print more oil. So I think he's seen enough history to say, hey, there's an elevated chance that we have elevated inflation in the years ahead, in which case things like oil producers might perform very well, especially if you're able to buy them at a reasonable valuation like he's doing with Chevron. The question is, what happens to various different energy prices? What happens to Exxon in the years ahead? First, if you're looking to take charge of your investment journey, consider unrivaledinvesting.com for compelling investment ideas, real-time portfolio updates, and our exclusive Discord server available for annual subscribers. In full disclosure, not financial advice. Looking at the price of energy, types of crude, it's really interesting to see that crude prices are actually down from their highs earlier this year when it was trading around $120, $130 a barrel. That was, post the immediate invasion in Ukraine. And now it's lower. And here it is. You're seeing Exxon making new highs, all-time highs. It does make me wonder, well, what's the market pricing in? And I think part of it is the fact that the market's saying, hey, and this is Exxon actually, this is their slide saying, look, industry investment is not keeping up with recovering demand, and sort of saying, hey, the required investment to keep up with the demand for various different oil products isn't there. So when you have this mismatch, you're more likely to have potential price spikes in oil prices, potentially resulting in much fatter margins for a company like Exxon or various different oil producers, because broadly as an industry, the investments aren't being made to accelerate production. And then another way to look at it, this is based on EIA and HFI research, is that energy inventories are down significantly relative to the last decade, creating the risk of a sharp energy price spike in the year ahead. I mean, this creates the risk of, could you see a situation where, let's say, oil automatically spikes to $150 or $200 a barrel, which really jolts the economy? And I think part of this dynamic, I think I'm not the only one who's aware of this risk. Clearly, Warren Buffett's putting tens of billions of dollars, where he thinks, is an attractive opportunity. You're also seeing JP Morgan's Jamie Dimon, who runs JP Morgan, effectively saying, look, the U.S. should be pumping more oil to avert war-level energy crisis. So I think he's very cognizant that this type of situation could play out. You could see a price spike in the future. And so it's very interesting to see this aspect. And one might even frame this as an asymmetric risk reward, because you have the Strategic Petroleum Reserve being used up effectively to suppress energy prices for now. But that is a sort of a Band-Aid solution. And so the White House is saying, yeah, we're going to have to refill these reserves that we're effectively using up. So we might start buying oil back at around $80. So, if you have oil at $80, these companies are still making tons of free cash flow. So it does strike me as a very interesting asymmetric type of setup, because, on the one hand, if the U.S. government says, hey, we will step in at $80 a barrel, and on the flip side, you might be looking at, let's say, $150 per barrel, type of shock. This is a very interesting, and by the way, it's not trading at a crazy, expensive valuation, 7-8 times free cash flow. My chief concern when I look at this is, what if there's some sort of broader economic slowdown or economic shock where, even though the investments in supply haven't, gone up the way management thinks it should with Exxon Mobil, and you see it broadly with the industry, with inventory levels, my concern is what happens if underlying demand comes under pressure because of the, monetary tightening that we've seen from the Federal Reserve. Now, if that happens, arguably, oil bulls might say, hey, that's just delaying this bull case for, let's say, 6 months, a year, where you could still have this sort of mismatch. I look at this and I'm sort of thinking, well, Warren Buffett, he's clearly putting in tens of billions of dollars. I think he's thinking about this for the long haul, that's sort of saying, hey, if we're in for a period, potentially years of elevated inflation, owning an oil producer might be a reasonable hedge against higher input costs for the rest of his sort of ecosystem that he operates. Keep in mind, Berkshire Hathaway is this huge conglomerate, owning various different things. So I do own a bit of various different oil play, and I call that out to my Unrivaled Investing subscribers. It's one of my top, 5 positions, sort of a levered bet on a particular oil company. And, I look at this and I struggle with it, in all honesty, because I think these are commodity companies at the end of the day, but there's sort of an asymmetric industry aspect where it doesn't seem like the supply generation is, effectively keeping up with where demand is, based on arguably a very, a warm economy. It's been running hot with high inflation. And so that's sort of the question of, like, well, how long does this last? And, what happens if you sort of, the Federal Reserve, squeezes a little too tight and something breaks, and then it's like, oh my gosh, energy prices drop. Now, in that scenario, once again, is it asymmetric? Because do you just have the White House say, oh yeah, now we're going to start buying oil, at $80 a barrel. So you sort of have that backstop, in which case, these companies still generate, 30, 40 billion in free cash flow. Maybe it's not the, 50, 60 that Exxon could have generated. Maybe it's only 30, 40, but in which case it's still very cheap. If it does 30, 40 billion in free cash flow for the next decade, and it returns, most of that to you as shareholder, you're going to do fine. You're going to recover your investment very quickly. And so that's sort of the challenge that I have with this. Personally, I would rather put most of my capital into a company that I think has longer term growth trajectory. A lot of folks are aware that, hey, we're transitioning from, effectively the fossil fuel industry. And so I'd rather look for something that has that longer tail growth. But arguably, looking at oil prices, it's like, man, they're making new highs. This is one of the spaces this is probably one of the only sectors that's working in the economy right now, looking at various different, what's going on in the market. So it is, I'm struggling with it. I'm struggling with the challenge here, because you see the low free cash flow multiple. You see that the price action's working. on the flip side, almost everything else on the tech and, high growth sector, that's not working out that well. And there's not a lot of, great free cash flow companies trading at compelling valuations. So it is a very, tricky sort of setup. If you have an opinion about oil or about Exxon Mobil, I'd absolutely love to hear it. And if you enjoyed watching this video, please make a point of hitting that thumbs up, hit that subscribe button. Thank you for watching Unrivaled Investing.